Friends, welcome to the BFM Crash Course Unit number 5, one of the most important, highly weighted topic from where almost you can expect 5 to 10 marks question from a single chapter. And if you go through the BFM Macbrand book, this chapter is covered in almost 20 to 30 pages, and we are trying to cover most important content out of them in the next 20 to 30 minutes. So listen to each and every word. Everything will be presented in the form of flow chart, mind map, so that you can easily retain it for longer time. And just after going through this lecture, I request you to please solve the MCQs as well as the quizzes which I have added in the crash course folder. Now let's get started. So friends, let's get started. Have you ever wondered how international trade in India runs so smoothly? Who set the rule, which authorities are involved, and what control the entire system? Well, in the first slide, let's simplify and understand India's international trade regulatory landscape in the most engaging way possible. Friends, these keys are not just for unlocking doors, they actually help us unlock the framework of international trade in India. That's what I'm talking about. Each key represents a vital component of this regulatory system. First of all, we have export trade. Let's start with the export trade. Friends, in India, it is primarily handled by DGFT, the Directorate General of Foreign Trade, which comes under the Ministry of Commerce. DGFT set the policies and procedures for the export. On the finance side, the RBI, through FEMA, issues export-related guidelines to ensure a smooth financial transaction. If we look at the import trade, then once again DGFT is in charge of governing how imports are handled in India. And when it comes to import payment, RBI steps in, guided by FEMA rules. So together, DGFT and RBI ensure both policy and payment sides are regulated under international trade law. Then we have exchange control. So foreign exchange control plays a central role also. Whether it is export or import, exchange control applied to all foreign trade transaction. And yes, RBI and FEMA are again at the core of the system, regulating the money flow. Then if we talk about the regulatory responsibility, so who does what? RBI regulate exchange control, manage foreign exchange receipt and payment, act under FEMA 1999, and issues policy guidelines. These are undertaken by RBI. And if we talk about DGFT control trade regulation, issues India's foreign trade policy, make regular policy announcement, all with one aim: to expand and regulate India's international business. So the next time you come across a question about foreign trade, export rule, or FEMA in an exam or real world scenario, just remember the key player: DGFT, RBI, and FEMA, the real game changer of India's trade framework. Now friends, let's shift our focus to the next slide, that we have export and trade control guideline. Every aspect has been covered in just one slide. Let's go through it. Friends, if you feel overwhelmed by long slides, long lectures, almost 3 to 4 hours of a single subject, and the very short time you have, then this crash course will be super helpful for you, because our main motive is to not just focusing on more theory. Our main motive is focusing on more MCQs practice. That is what is required at the right time. And just by going through this video, which takes almost 20 to 30 minutes, you will be able to cover many main topics from where question are asked, and our main focus should be on solving MCQs. Now let's see. Basically, have you ever wondered what goes on behind the scene when goods cross international border from India? Well, in this slide is a breakdown of the export and trade control. Here you can see export and trade control guidelines. So first of all, let's begin with the first key element, that is called IEC, also called as imported code. Let me zoom in. Now friends, this is mandatory, right? This is mandatory for anyone who wants to engage in international trade. The IEC number is issued by DGFT. Who issued it? DGFT issued it. And it acts like an official license to trade globally. And now if you are dealing with services or software, then there are additional registration. Like if you are exporter of services, then registered with SEPC or FIEO. And if you are exporting software, then you need to register with STPI. Now the IEC must be quoted on the all export or import form. It is the first step to make your trade journey legitimate and smooth. Now let's talk about the second part of it, that is called EDF. Let's take to the export declaration form on the right hand side of this. So friends, moving on, we have export declaration form, the second key piece of the puzzle. Now as per the subsection 1 and 3 of the FEMA, every export must be declared. Why? Because this ensures full value is realized within the prescribed time. So every export must be declared. There are two types of form depending on what you are exporting. The first is called EDF form, for physical export via any mode, that is EDF form, export declaration form. And second is called Softex form, is specifically for non-physical software export. So these declarations are not just formality, they are critical for regulatory compliance. Then we have something called EDI, that is called electronic data interchange. So now comes the real game changer, electronic data interchange. This is where digital meets custom. At selected custom office, EDI enables electronic processing of shipping bill, making trade faster and more efficient. Previously, trader used the GR form, but now that has been replaced by the EDF form, right? So GR form has been replaced by the EDF form. Now here is how the process flow. First of all, submit the EDF form in duplicate along with your shipping bill. Hand it over to the commissioner of the customs. Once authenticated, an exchange control copy is returned, and this copy is then submitted by the exporter to their authorized bank. So this process follow, right? So process will not be asked, but you must remember the forms: ED forms, EDI forms, electronic data interchange, right? And GR form. Previously they used the GR form, but has been replaced by the EDF form. And how the process work entirely, this is now. So remember the trio of IEC, export declaration form. Let me zoom out. So these three trio: IEC, export declaration form, and EDI. These are the real backbone of India's export regulation system. They make sure everything is tracked, authorized, and verified. Wasn't that simpler than you thought? If you are finding this breakdown helpful, do hit like, do share, and do subscribe. Right, so because we make complex thing easy to understand. That is our main motive from this particular slide. Now friends, let's decode one of the most crucial yet overlooked aspect of international trade, that is called export bill realization process. In this entire mind map, everything will be cleared that how export bill is realized. So because exporting is not just about shipping goods, it's all about realizing your payment on time. Let's dive in step by step and make it crystal clear. First of all, export initiation. Once the goods are exported, the clock start ticking. Exporter must ensure that payment is realized and brought back to India within a stipulated time. This is the beginning of the export bill realization journey. Now as per the general rule, the full export value must be realized and must be repatriated to India within 9 months from the date of export. Simple but strictly monitored. Right, so that is called general rule application, that the full export value must be realized and must be repatriated back to India within 9 months. This is very important thing. Full export value must be realized and repatriated within 9 months from the date of export. Simple but strictly monitored. If we talk about the relaxation provision, now what if your goods are headed to an overseas warehouse? So with RBI permission, there is a relaxation. So the realization must happen as soon as the goods are shipped, but you get a maximum of 15 months from the shipment date. RBI or your authorized dealer may also extend this period only if there is a valid reason. Now, and let's not forget the special COVID-19 relief measure, right? For export made up to 31st July 2020, the realization period was extended from 9 to the 15 months, a much needed breather during tough time. Now friends, let's talk about SEZ and EOU rule. Now, if you are operating under a special economic zone, an export oriented unit, or hold a status exporter license under these three, either you are SEZ, EOU and status holder exporter, this one is for you. You follow the same 9-month realization and repatriation rule, but with a twist. What is the twist? The twist is that RBI or your authorized specific sub-regulation. So compliance is not optional, it is essential. That is the point. So to sum it up, time-bound realization is the backbone of healthy export trade. So follow the standard 9-month rule, understand the relaxation, and always stay compliant with RBI direction. That is the point. Now friends, let's shift our focus to the next slide. Ever wondered how Asian countries manage payment among themselves without constantly draining their foreign exchange reserve? Let me introduce you to a hidden gem of the regional cooperation, that is called Asian Clearing Union or ACU. So the Asian Clearing Union was established on 9th December 1974 with its headquarters in Tehran, Iran. And guess who initiated it? The United Nations Economic and Social Commission for Asia and Pacific, that is called UNESCAP. You may also remember the formula. So UNESCAP has introduced it, right? The mission was simple: to make trade settlement among Asian countries easier, smarter and faster. Who are the member countries? So member countries are asked in the examination. Which among the following is not a member country? So remember, there are 9 member countries: Bangladesh, Myanmar, Pakistan, Sri Lanka, Republic of Maldives, Nepal, Bhutan, Islamic Republic of Iran and India. This question is asked, that's why I have included here. Every aspect which I am dealing with, please don't underestimate the importance of that thing, because they have been appeared in the examination. That's why it is there in our crash course. We ensure that all the topic from where question has appeared in the last 5 year, almost 10 paper, we have collected the data, and based on that what I am providing you, please take assurance that if you get any question, that there is a chance that concept get repeated. Question don't get repeated, concept get repeated. Now friends, let's look at the objective of this ECU. So what does ECU aim to achieve? So let's break it down. First of all, enable multilateral payment among member nation, reduce the use of foreign exchange, cut down transaction cost, and most importantly, promote regional trade. It's all about simplifying, saving, and supporting each other. That's the goal. Now if you look at the currency used, so how do they do settlement? So ACU operate using 3 specific currency: ACU USD, ACU Euro, ACU JPY. So these are not new currency but representation. They function like USD, Euro, and JPY but are settled under ACU framework. Now let's look at the working. How does it work? So when two member country trade, the proceeds are settled in ACU USD, ACU Euro, ACU JPY. Then they go through current currency specific account maintained with the authorized dealer, right? So there is a currency specific account maintained with the authorized dealer through which this proceed go through, and the currency are treated as a standard foreign currency but are just denominated under ACU system. Smart, seamless, and region friendly. So that is in Asian Clearing Union, a brilliant example of regional collaboration, making trade more efficient and less dependent on external currency. Now friends, let's shift our focus to the next slide that we have, that is called facility for exporter, remittance and invoice reduction. So now let's look at this slide. Exporter, listen up. Did you know that you can offer discount or invoices or earn commission without breaking any rule? Yes, the RBI has laid out crystal clear guidelines to help the exporter handle remittance and invoice reduction like a pro. So let's start with something called invoice value reduction. Let's start with on the left hand side. So when can you actually give a discount? Only in these specific cases. First, cash discount to overseas buyer. Second, prepayment on usance bill. That's a credit based bill. Now what are the conditions? The conditions are that discount are only allowed for unexpired period. So basically, exporter can offer discount on invoices or earn commission without breaking any rule. So discount can be given in cash discount to the overseas buyer or prepayment on usance bill. Now what are the conditions? The conditions are that discounts are allowed only for the unexpired period, right? And interest rate must be either pre-stated or as per the applicable reference rate, which we call ARR. What is ARR? Applicable reference rate. Now there is something called post bill negotiation or collection. So post bill negotiation reduction. What about the discount after the bill is negotiated? Here is what is when it is allowed. So that if the bank call the authorized dealer, verify the genuineness, reduction is capped at 25% of the invoice value. It is not applicable for price restricted commodities, and the exporter should not be on the RBI caution list. So yes, you can reduce but only with check. So what about discount after the bill is negotiated? Yes, you can reduce. After the bill is negotiated, you can reduce, right? But there are some conditions that the bank verify the genuineness, reduction is capped at 25% of the invoice value, not applicable for price restricted commodity. There are some commodity where price is restricted, it does not apply to that. Post bill negotiation, right? And the exporter should not be on RBI caution list. Now full reduction, tell me whether full reduction is allowed or not. Full reduction, let's talk about it. So, and guess what, in some cases there is no limit at all. A full reduction is allowed if the exporter has been in business for at least 3 years. Remember, in those cases where exporter has been in business for at least 3 years, then full reduction is allowed. Or exporter has a satisfactory track record, then full reduction is allowed. Or exporter keep export bill write off within 5% of the average annual turnover, then full reduction is allowed. So these 3 conditions, follow this and you are good to go. Now special country specific relaxation. So what it means, and here is a bonus, a special relaxation for tricky country. If a country has externalization issues, exporter can ignore the export realization requirement, right? So that is the point. So what I mean to say that if any country has externalization issue, exporter can ignore the export realization requirement only if the buyer pay in local currency. So RBI got your back even in tough market condition, right? Now let's look at the second part of this slide, which is our agency commission. On the right hand side you can see friends, now let's talk about agency commission. Exporter can pay this through direct remittance or by deducting it from the invoice, either through direct remittance or deducting from invoice. So here is the rule: if the commission is declared in EDF or Softex form and accepted by the custom after shipment, you are clear. And if it is not declared, don't worry, ED can still approve it provided there is a valid agreement and the shipment is completed. So whether you are discounting discounting for early payment or rewarding agency overseas, it is all allowed as long as you follow the guideline. As an exporter, you should follow the guideline, right? So that is all we have covered in this particular slide, and question based on them are most frequently appear in the examination. That is why they are there. Now friends, let's look at a very important slides. Let's talk about it. Ever wondered what happened when export payment don't come through? Well, exporter are not left hanging. The RBI give clear option to write off such unrealized export bill. Let's break down the entire process visually, simply and smartly. First of all, let's talk about the exporter option for write off. On the left hand side you can see. So let's go through it. So friends, first of all, what can exporter do on their own? So they can go for self write off by approaching an AD category 1 bank with supporting document. But wait, there is a limit. That exporter can write off 5% of their export realized in the last calendar year. And if you are a SEZ unit or a status holder exporter, good news, you can write off up to 10%. So for general it is 5%, limit is 5%, and if you are SEZ unit or status holder exporter, you can write off up to 10%. Now let's talk about the AD bank write off. Let's talk about on the right hand side. So now what if the exporter want the bank to handle it? So authorized dealer bank can write off up to 10% of the export value realized in the previous year. But there is more. There is also a cumulative limit on write off, so it add up over the time. Now the question is, when AD bank can write off without limit? Now this is important. There are three scenarios where AD bank can write off the entire amount without any limit. First condition, if the overseas buyer become insolvent, just show the liquidator certificate. Second condition, if there is a settlement through embassy or foreign chamber of commerce. And third condition is that if the goods are auctioned or destroyed by the custom or other authority. So in all these three cases, no cap is applied. They can write off the entire amount. Now the third case is effective date of realization. So, and finally, what is the effective date of realizing export proceed? So see, two conditions are there. First is for foreign currency bill. If the day foreign currency bill, it is the date the money get credited to the bank nostro account. So that date on which money get credited to the bank nostro account, that is the effective date. And for rupee bill, it is the date the money is debited from the vostro account. That is what bank used to track timeline and calculate interest. So for foreign currency account, the date money get credited to the bank nostro account. For rupee bill, it is the date the money is debited from the vostro account. So remember these two conditions. Now one more thing, that foreign currency bill value date. The value date of credit is super important, and it is what is used for interest calculation on delayed payment. So remember, whether you are writing off bad export due to tracking foreign credit, it's all about understanding your option and RBI rule, right? So that is all what has been covered here. Now friends, let's talk about comprehensive pre-sanction criteria for export credit approval. First of all, customer status. So pre-sanction assessment. So ensure that borrower is an existing customer of the bank. IEC requirement, importer exporter code. I told you that verify that exporter hold a valid export import code. So pre-sanction criteria, that means pre-shipment criteria. So the exporter has not shipped the good yet, and the bank is financing the exporter before shipping the goods. That is called pre-shipment. So these are the conditions which bank must ensure. IEC requirement is there. RBI caution list, bank has to check that if the exporter is not on the RBI caution list, and ECGC approval list. So confirm that exporter is not under ECGC specific approval list. So these things bank have to ensure before extending the pre-sanction limit, pre-sanction financing or pre-shipment financing to the exporter. Now the next thing is that KYC compliance is also there. So mandatory full KYC adherence, credit limit, expected turnover plus input cost, finance limit is lower of the FOB, free on board or domestic, and CIF order. So then if C, deduct 13 to 14%, which is freight plus insurance, and if it is air, then deduct 25% of FOB, and then deduct the profit margin. And pre-shipment credit tenure is normal, it is 180 days and extendable up to 360 days, and up to 360 days no concession interest apply, and interest rate is linked to the MCLR from 1st April 2016, right? So strict on viability and borrower interest and credit view, combined pre plus post shipment assessment, right? That is what it is. Now let's talk about the post sanction monitoring. So stock monitoring, take a stock statement. There are some special cases like sub supplier, running account, oil seed export restriction. These are some special case, and country risk awareness regulations and environments are followed. ECGC intimation via WTPC and WTPS, right? Export proceed, advanced liquidation in the case of export bill and post shipment advance. And buyer due diligence is required, credit report should be taken, LC verification should be done properly, no double financing. This should be ensured by the bank, right? So that is the point during the post shipment finance. And now this is the very important chart, export bill finance condition. There is something called NTP, normal transit period. It is applicable to the foreign currency bill, and it is fixed at 25 days. Remember, normal transit period is how much? 25 days. Now, if we have few due date exchange bill, it is based on bill of exchange. NTP is not applicable, and concessional finance period is the time till the actual date. Now, one more thing I want to tell you, that this is regarding the NDD. You know what is NDD? Notional due date. So remember, if it is demand bill, NDD is equal to date of handling plus 25 day NTP. And if it is a UJANS bill, then NDD is equal to UJANS bill plus 25 day NTP plus grace period. So this is how we calculate NDD. Now, concessional interest rate period. For demand bill, concessional interest rate period is up to NTP, which is 25 day, and for UJANS bill, you add transit, you add UJANS, and you add grace period, and that is up to when concessional interest period will be applicable. And all these things we have done a case study to understand all these things, and that case study has been added in Crash Course folder. I request you to please go through the Crash Course, right, so that you can understand the application of these concept which I have told, which I have shown. What is NTT, what is NTP, what is NDD, what is concessional interest period. There is a case study. After solving that case study, you can easily understand all this data. So friends, that is all you need to understand. And one more thing, that advance remittance for import of gold. So what should be required? Valid import license should be there. That importer must hold exchange control copy of the valid license, and goods should not be on the negative list. Authority, that AD and conditions are there, right? If it is so, see, one more thing is very, very important, that you know that if the amount, right, if the remittance amount is between 2 lakh and 50 lakh dollar, right, you can see 2 lakh and 50 lakh dollar, then bank policy and RBI approval is required. And if it is, you know, above 2 lakh, letter of credit via guarantee, and without guarantee, if it is up to 2 lakh, then no guarantee is required. Due diligence is necessary, right? And mode of remittance, it can be either overseas supplier or it can be either supplier bank. And documentation required from importer, proof of cost, and you know, supplier insistence. And you know, if unable to secure guarantee for remittance exceeding 1 lakh dollar, it must obtain a waiver from the Ministry of Finance, Government of India. And if we talk about the timeline, then within 6 months from the remittance date, 3 years for capital good, an importer must undertake to submit documentary proof within 15 days of the end of the timeline. So these are the conditions. So that is all you need to remember. Using this particular timetable flowchart, you can easily understand it. So friends, that's all for this particular chapter. And we'll see, these are the theoretical thing, but from this topic, you know, numericals are also asked. So which kinds of numerical are asked? Just now I told you, calculating NDD, calculating concessional interest rate, calculating, you know, NTP. So such kind of numerical are asked. This can only be understood if you go through the case study, right? So that's all for this particular topic. If you want such kind of PDF to revise the entire content in short period of time, you can enroll in our Crash Course program or capsule course also. In both PDFs are available, right? For more detail, you can WhatsApp me on the number provided in the description section. Stay tuned, subscribe the channel. I will provide you more lecture like this. Thank you.